yeah, so this is my first time trying out live stream on YouTube, so that's why going to be a little bit of bumps in the road, but thank you for that, Vince, also. And so, yeah, I want to start off by letting y'all guys know what I've been up to and why I've been gone for about a month. I've been working from home all summer, fortunately, so that's been great, but work's been really busy, and I decided I needed a little bit of a mental break. And then also, yeah, Vince, instead I'm going with yerba mate today. I needed a little more caffeine. So, but next time I will have my Diet 7 Up to keep you proud. But yeah, so basically I've been doing a bunch of different stuff with my girlfriend. Who's in the chat as well, and we've been doing a lot of hiking and camping, and it's been great. And I'm going to share a couple pictures of that with y'all before I get started on topics, just so you guys can see what's been going on. And don't be panicked by what OBS looks like. Yes, it's very weird. Okay, cool. So, yeah, so it's been really great. Basically, we went and did a bunch of hiking. We went and hiked Mount Baldy, which is a pretty good warm-up hike because, and then I built and then we've been doing a lot of making stuff at home. I know Ryan from Financially Fashionable on YouTube will really appreciate this, but my girlfriend got me into making homemade boba, so now I'm able to whet my Thai tea appetite anytime I want, which is pretty amazing. Then we went and hiked at Mount Langley, which is like a 14,000 foot peak, and warm up for Mount Whitney. This is a picture of the night sky from there. It was a great time, and it was her first 14er, so it was really awesome. And next time we go, I'll definitely get a lot of video of it, but needed to make sure everyone was okay this time. And then this is us at the top, and yeah, it was a great time. And then this is her contemplating whether or not she wanted to date me anymore. So that was right before the last climb to the peak. So good news, she does. So, and this is on the way back down. And as you can see, so this is why I took a month off, is to have this type of time. And then I built an editing PC because I've been using a laptop with no SSD and like 128 gigabytes of memory and only 8 gigabytes of RAM. So now I've updated my PC, so my editing and streaming should be much better with, I think 1 terabyte of SSD, 4 terabytes of HDD, and then 32 gigabytes of RAM, and that's with only 2 sticks, so I can even upgrade that to 64 if I need to later. So yeah, that was pretty awesome, and that was a good learning experience because, that's what you use this extra time for at home. And then Mount Whitney, which was the really fun part. That was our last big hike of the year. It's the highest peak in the lower in the mainland United States, the 48 contiguous. And this is us getting started. She was a trooper getting up at 1 a.m. to hike this. And then, the sun rising. It's beautiful. Like, I think that's one of the good things that I have about the pandemic is being able to have more time to spend with my girlfriend and with friends. And so that's been a really great thing. Here's some more, just some really pretty shots I wanted to share. And definitely follow me on Instagram. You'll see all this stuff. But yeah. And yeah, it was a great time. And anyway, that gives you a little bit of an idea of where I've been and what I've, what else I do outside of this. And yes, it has been, Nikki. It's been amazing. I left out all the grill pictures because it's lunchtime and it's lunchtime-ish here and dinner time in the East, so I don't want to make everyone leave to go eat. But yeah, so it's been great. I'm just showing y'all a little bit of an outline here of what I've been doing. Yeah, showing y'all a little bit of an outline. But basically, it's been great because of working from home, being able to spend time. I started cutting my own hair, which was really a fun, interesting time. And then I had more time to read, been taking time off from BJJ to let my body feel normal, which is great. And yeah, now let me pull this back up. Dope. Okay, cool. Now, then in the future, I plan on doing this. I decided that it's really hard for me because of my work to have a full life, and the awesome. Thank you, Vince. Appreciate it. Yeah, it'll only get better, I promise. But yeah, so in the future, I decided that this is the best way to. I know Vince does a really good job of doing daily uploads, and I do not have the time nor bandwidth to do that. But what I decided is that I have so much that I want to talk about, and I think it's going to be better for me to do in this format in the future, where I, have a live stream with several topics. I can answer questions, and then that way I'm able to cover much more and do it in a way where I am forcing myself to not put it off because I need to do better at that. So with that preamble, I'm going to get started with the topics. So the first topic I want to talk about was stock splits. So I know recently it was a real question because Apple and Tesla both did splits on their stock. So first of all, let's go over what a stock is. So essentially a stock is a share of a company. So you have a private company that is publicly traded on a stock exchange. And basically the idea is that, like, say a company is worth $1 billion. If it's worth $1 billion and there are 1 billion shares, then that would mean that each share of that stock would be $1. So a stock split is where, say, a stock price gets up above a certain price, where the company thinks that it is prohibitory for people that don't have a lot of money up front to invest. What they will then do is they will cut the price of that stock by some percentage in order to attract new investors. And let me share with you a worksheet so you can see what I'm doing. But basically, what happened recently was that Apple is, say, a 1.9 trillion valued company. So earlier, Apple had, in the August 11, when they announced their stock split, Apple had, the shares were about $470 per, and they had about, they had 4 times as many shares, right? So what happened is they took that $472 share, they did a 4-for-1 stock split, and essentially what that meant was that if you had a share of Apple that on the split date of August 24th, then you would end up having 4 shares of Apple. The amount of money that you had invested in wouldn't change at all, nor would the valuation of the company, because they've essentially just divided it up into more pieces. It's kind of like if you were to sell pizza by, the half versus pizza by the slice. It's just divvying it up in more, so it doesn't actually change the value of the company. And this causes a lot of confusion for young investors. I know, as an example, my brother texted me because of Tesla stock split, because that's one, of course, everyone wants to invest in Tesla. It's a hot stock that has a lot of hype behind it. It's, and it was very, very high sticker price. And sticker price meaning the price you would pay per share of stock, not considering fractional shares. But basically, when you look at it, it was at about $1,700 when they announced their stock split, which most investors are not going to be able to do, because most are starting off with, say, $1,000, or, even if they are at the $2,000, they don't want to put all of it into one company. So it was a real issue. So Tesla decided that they were going to do this where they did a 5-for-1 stock split. So essentially they would, add 5 times their amount of total shares, which would bring the share price down. That hopefully would attract new investors. Well, what you saw happen was when they announced it on 8/11, right? You saw this huge run up in Tesla's stock where basically, where's 8/11 on here? Yeah, so basically right here, 8/11, literally the day that they announced it, from that point forward all the way up to, and right here, all the way up to right whenever, around the time, right at, like, about a week after they announced it, it's had a precipitous drop. Now, the market as a whole has had a precipitous drop, which is definitely something to consider. However, when you look at Apple as well, it's exactly the same, or not as extreme as Tesla, but very similar. And this is important to understand in the future when you're looking at what to buy and what not to buy, that it's always going, pretty much always, especially if it's a hyped up stock, one that a lot of people know of. Like, if you ask an individual person, like, oh, what company are you going to invest in? And they don't know anything about the market, or they don't know anything about, PE ratios or any specific stock, the first stocks that are going to come to their mind are going to be Tesla, Apple, Amazon, Microsoft, Google, those companies that we all know are stalwarts. And this is important to understand because you saw institutional investors start buying it up as soon as it was announced, and that's what pushed the price up like crazy. And then you had it gets slashed in price. So all these people that were beforehand were not able to afford to buy into Tesla, then start buying it. And then they keep doing that, which keeps pumping it for another week. And then the institutional investors go in and they sell. And that's where you see those drops, because they know they're taking advantage of the psychology behind what makes people view stocks as cheap and not cheap. And that's it's an important thing to understand. Now, then let's look, and basically the idea is you need to think of it like this. It's not actually changing the fundamental value of the stock, and you should never buy a stock because it's splitting. You may be able to speculate on it, i.e. like when they announced it, if you were in the position to, you could buy it because you assume that there's going to be a run up. But in my opinion, that's not a very sound investing strategy. That's more so gambling. And I try to stay away from gambling because the odds are not on your side, generally speaking. But it's an important thing to understand. And long term, the best way to look at it is, what's the valuation of the company? Is that valuation lower than it should be? If it is, you should buy it. And if it's not, you probably shouldn't. So let's look at what's going on in the chat here. Yes, thank you. I appreciate that, Chris. I agree with you. I definitely will upgrade my furniture when I move, and my bedspread. But now let me move this back out. Awesome. Okay, cool. Yeah, so the next topic I want to cover is and if anyone has any questions throughout, I will cover those questions at the end of each topic that I go over, just for cohesiveness and to make sure that everything lines up really well. So basically, over the last several months, I wanted to do a COVID catch up because I feel like there's so much stuff that's happened that I need to address, and it's much easier to do it in this format. So basically, we all know that COVID, has caused a lot of issues. We've had the highest unemployment rate since the Great Depression. We had the fastest 30% market drop since 1929 in the Great Depression. And, it's been devastating for for broad swaths of the economy. And, when you consider that 70% of Americans, live paycheck to paycheck and are, not able to afford about a $1,000 emergency, it really gives you, the perspective on like how big of a problem this is. Because, unemployment is, a huge issue, because it basically means that if people are not able to afford, to push themselves a little bit further than, each paycheck, then that means they're going to miss bills. And when those people miss bills, then that means that they don't have money, discretionary income to spend on other things, which if people aren't buying stuff, then the economy is going to become stagnant because nobody's stimulating it. That's how the American economy works, is we need people at the bottom spending money in order for the assets to raise in price, and therefore the business owners to be able to make money, and therefore employees to be able to make money and to keep them on staff. So this is a huge issue that we, are having to deal with and have been having to deal with. And so far, the government fix has been that, and I say fix very loosely, but the government fix has been a one-time $1,200 stimulus check, a increase on unemployment benefits, which they did through the end of July, from $200 per week to $600 per week. And this is a huge issue right now because currently it's been, because the unemployment benefits, the additional unemployment benefits expired at the end of July, they're talking about what are we going to do going forward. And I know it's been shown that, that Trump put out saying that he wanted to have a extra $400 unemployment benefit, and that he signed a measure to do that. But the problem with it is that it is putting the onus on the states, and the states often don't have enough money for this. And one really good, and I will put all of the links if you want to catch up on this later, but I'll show you right now in the description for afterwards. But let me show you what I'm looking at. But basically, there we are. Awesome. Yeah, so basically, when we're looking at this, so here is the, let me make sure that's perfect. Okay, so basically when we're looking at, okay, cool. Yeah, so basically when we're looking at this, here's a good chart from CNBC showing the CARES Act and what it's done. So the CARES Act is the raising of $400 on top of the $200 that you would normally get from unemployment benefits. And it's showing the difference based on the state that you live in. And so essentially what's happening is you have the original $600, which is the CARES Act. Then you have the $400 that's being proposed, and then you have what it would normally be. This is within each state, and you can see it varies pretty wildly. And more so, I think the thing you can see is that this is a huge disparity. I mean, it's going to be a really big issue if we don't do something in order to, help normal people. And putting the onus on the states is not a great strategy. I mean, especially if you look at, say, like Louisiana, you're looking at under $200 versus almost $800. That's pretty huge. And most economists, at least from what I've seen, they have a very negative view of whether or not states are going to be able to actually afford to do more than the $300 a week that, a lot of them are already committed to. So I feel like this is kind of just passing the buck on to the states, and it only serves to hurt the average person. So I think this is something we really need to pay attention to and be on the lookout for. And if you are someone that's dealing with, unemployment or, in a situation where, you're looking at, needing to use these benefits or similar benefits, definitely be, constantly looking for those because, we need something soon, and definitely be looking at what politicians in your area are supporting you as an individual, and keep that in mind. And then the other thing that they've been doing is the bailouts. So this is another one to look at. Is basically companies have been doing. Basically companies have been. We bailed out a lot of companies through the PPE loans, and we there's actually a pretty cool tracker that I'm showing here, and it essentially shows the amount that we have given to them and the amount that those companies have given back, and that's been a pretty cool thing. Now you can actually fully see it, but basically the idea is that here's the amount that we gave them. We being the taxpayers gave them through these bailouts, and then here's the amount that they have either paid back or not paid back. And so as you can see, what was a good thing that they did, and they did this in the 2008 crisis as well, was oftentimes when the government would pay out, bail out these companies, they would end up taking an equity ownership stake. And that's how they're getting these additional benefits, is from the equity in that company raising up since then. And when I say that, what I mean is essentially the valuation of that company. So when its stock price comes back up, if the U.S. government owns a specific amount of that company, then it's going to go up by that same percentage. And so this is something that'll be really cool, and I'll have linked in the description for people to see. So I think that's definitely something to check out if you're interested in understanding how those bailouts have worked. Also, one of the most prominent bailouts has been the airline bailouts. And this is something that is definitely personally a thing that I think about regularly, because my father and my brother actually both work for two of the major airlines. And you knew essentially the bailout bill for the airlines. What ended up happening was that they gave a certain amount of money to the airlines with the condition of keeping employees on and not furloughing or firing people through October. And this was something that was very harrowing for knowing people that were in the industry, because the problem that you realize is, oh, well, that means that they're going to, furlough and fire people as soon as it's October. Like it's a very obvious caveat that they put in there for a reason. Now, the positives are that they got government equity in it. So I believe it's the U.S. we own now like 1% stake in Delta and Southwest. Yes, cool. That's what I was thinking. Yeah, so essentially what ends up happening is that we did get a 1% stake in Delta stock at 24 per share, which is a great thing for the future growth of that, because that's a pretty good price for Delta. But the bigger thing we have to keep in mind is, and what a lot of like flight attendant unions and airline pilot unions have been talking about, is that it doesn't do much to help the average person, because those workers are still going to be out of a job. And all this really is going to do, at least historically, all it's going to do is serve to raise the, benefits that holders of that stock, CEOs and other executives that are paid mostly in the shares of that stock, it's going to help them. And yes, we are going to get some benefits because of that equity stake. However, I think it would be much more. I'm very disappointed that Congress, allowed and specifically put in that caveat. I feel like we should keep people on, because airlines at this point in history, they're essentially a utility. Like they're as important as a public utility as any other travel industry, and I think we need to make sure to support those workers. And so that's been a real issue that I've been thinking about lately. Let's fix this back. Dope. Okay, and then and so on top of the federal government, there's also been the Federal Reserve. So the Federal Reserve is essentially the bank. It's the lender of last resort, is what you would refer to it as. And basically, the idea is that the Federal Reserve sets interest rates, which interest rates are the amount that you pay in interest on a loan in order to borrow money. But the Federal Reserve specifically does it for sets the interest rate for banks to borrow money. What this does is, this means that when they lower federal interest rates, that it lowers the cost of a loan, and when they raise it, it increases the cost of a loan. So what the federal government, or what the Federal Reserve has been doing, has been lowering the federal interest rates to make money cheaper. That way banks are more likely to loan it out. This is a way of stimulating the economy, because there's more liquidity. There's more money available for people to, have loans. And this is why you've seen things like real estate prices go up in areas, even though, unemployment is up. And you would think that, well, how's this possible? Well, it's because there's more money available. Interest rates are low. It's cheaper for people to, sign up a loan. So those that do have a steady job are in a very good position right now. And the Federal Reserve cut interest rates from about 1.75 to 1.5, and then they cut it all the way down to 0.25 to 0.0 or to 0%. And they did that in March, and they plan on keeping that for the next 3 years through 2023. But a lot of economists think that they'll keep it through 2024. This is really important to keep in mind, because so if you have, say, a high interest savings account, and you remember, say, having like 2% or more that you were getting an interest through like Ally or Tab or some other Wealthfront, some other high interest savings account, that percentage rate that you were getting is based on the federal interest rate. So you'll notice that has dropped off to almost nothing now. Well, that's a really big issue, because obviously we want to combat inflation. So cutting interest rates down, which then on top of that, they injected $2.3 trillion into the market in March. Those things, all they serve to do is increase the prices of assets, because there's more liquidity, and that means that there is more money that is going into those assets. When you consider that you're printing more money, there will likely be increased inflation, then that means that the only people that get left behind are those holding cash in savings accounts. So that's why it's really important to keep in mind that we need to be investing if we're capable, because you're going to get left behind in an inflationary environment, which all paper money is inherently inflationary. That's why it's so important to get started early. So all that considered, going forward, what it seems to me is that inflation is very likely to increase. There are some economists that do think that it will not. However, they're doing that based on a micro scale, at least from what I've seen. And specifically what I mean by that is they're looking at it from the perspective of the price of raw goods in, say, a grocery store or the department store have not risen. And so they're saying that everyday inflation is not occurring. However, when you look at, say, asset prices, and when I say asset prices, I mean real estate, stocks, those are going up, and it seems to be driven 100% by the Fed. It doesn't seem that there's, we shouldn't have seen price. You shouldn't see prices in a company, go in a company or the stock market as a whole, going up when we have, 40 million people unemployed a month and a half ago. That doesn't make sense. We shouldn't be like right now. It doesn't seem that we should be near all-time highs in the stock market based on the market itself. That being said, it is being driven by tech giants, which is another thing entirely. And that is why I think, and there's a really good video, I'll link it as well, from Economics Explained that he did, I believe, yesterday on why he thinks that this is going to be, and a lot of economists do, but thinks that this is going to be a K-shaped recovery. So a lot of people, talk about whether it's going to be a V-shaped or a U-shaped or a W-shaped recovery. And essentially all these mean is you're looking at a stock market chart and you're saying, okay, well, it dropped precipitously and then it rises fast. That's, a V. It drops precipitously and then it's like a little iffy. And then finally it comes back up. That's a U, drops, spikes, drops again because everyone panics again, and then finally comes back up. That's a W. A K is where essentially you have the stock market drop, and then you have, certain segments of the economy fully recover, and other segments of the economy continue to keep going down. And I'm in agreement with him that that's what we're seeing. We're seeing tech and companies that are benefiting from the at-home economy. Those are going up like crazy because they have all this extra liquidity in the market and the low interest rates. They're going to benefit from those. Meanwhile, you have companies like in the travel industry that, they're not going to recover until they're able to fully, utilize their, employees, their resources, and run their business fully. So no matter how much liquidity you put in, it's not going to make up the difference between the ones winning in this current economy and the ones losing. It seems to me that we need to do more specific work within those companies, helping them out because they're going to keep getting left behind. And sadly, the people that are going to get left out the most are their workers because those are the people that are the most vulnerable in this situation because of the cyclical nature of those companies. And this, of course, then increases the wealth gap in the U.S. I mean, you have people that, including, myself, where it's like, if you're able to even own, stocks, you are so much ahead right now because of the fact that we're looking at, well, one, if you have an emergency fund, you're already far ahead of 70% of Americans and, have far less financial stress. But then two, when you're looking at the ability to own assets right now, that is the key thing, because I think you're going to continue seeing asset prices, that's home prices and stock prices, go up without regard to what's happening with the economy because of those low interest rates. There's just nowhere else to put money. Like you don't want to put money in bonds. You don't want to put money, hold money in cash. If the Fed's going to pump stuff up, you might as well ride up with it. And that's kind of, I think, what you're seeing from institutional investors. And that's why you're seeing the recovery that has already occurred. And I think that none of these policies that have happened so far, the government or the Fed policies, are going to lower unemployment long-term. Yes, it's come down a little bit, but like I said, a lot of these bailout bills, specifically the travel-related ones, run out in October. I think we're going to see another another rise in unemployment. And I don't think that this style of quantitative easing and policy is going to do much until the virus is manageable long-term for unemployment. I think this really comes down to the difference between expansionary and contractionary economic policies. So essentially, expansionary economic policies are what we tend to do in a market where that is like a bull market. Expansionary essentially means that we want to lower interest rates, make money cheaper to borrow, cut regulations, lower taxes, essentially make money easy for people to get and to spend, and that it functionally grows the economy. Whereas contractionary fiscal policy which is far less politically advantageous with most people, is that where we want to raise taxes raise taxes in order to redistribute to areas that are more in need. We want to make sure that, we're not focused on necessarily revving the economy as high as we can, but making sure that those at the bottom have enough money to spend and to essentially stimulate the economy to make it through that downtime. Instead, we've seen oftentimes, and I'll do this as a topic in next week's video, we'll see companies like BlackRock, and other like vulture capitalists, as they would be called by many, come in and take advantage of these distressed assets when they're at a low price at the behest of normal people that are getting left behind in these expansionary fiscal policies. As for lessons that we as individuals can learn from this is that, it's so important to have an emergency fund. That's the number one thing that you should do after you pay off debt that's over like 4%. If you have, like 2-3% interest rate debt, it may not be that important for you to prioritize, in my opinion, over getting an emergency fund. That being said, you need to talk to a specific financial advisor about that. But essentially, if it's, lower than about what you can get in bonds, there's not much of a reason to prioritize it over getting an emergency fund first, because it's far worse to not have an emergency fund, get in a dire situation, and then have to take in high interest loans, whether in the form of credit cards or personal loans, just to save 2%. It's, in my opinion, there's nothing better than having an emergency fund for your like financial and mental like well-being, because it'll manage your stress a lot. And then, make sure that you're investing, because once you have an emergency fund, you want to make sure that you are, putting money in assets, because the reality is that the people that are writing laws, the people that are doing this policy, that's what they're doing. And so they're going to, they're going to essentially make it easier for themselves. So you're going to have to be a part of that if you want to not get left behind, sadly. And then as far as like jobs, you want to keep in mind when you're looking, if you're someone who's in school or you are someone who's at a job that, is not your long-term career plan, you want to make sure that you're looking at it from the perspective of, okay, well, what is this job going to do for me? I think it's really important. And that's, and I'll do this as well as a topic in the future, but it's really important because like I, as an example, work in a job where I work for, a company that essentially is, we're like essentially a nonprofit, unbiased third party that vets contracts for NASA. So my job is very stable. It's not cyclical or consumer based. And I think that's something we really need to focus on, because in the way our economy in the US is currently set up, it hurts people in cyclical industries very, very sharply, because we don't do enough contractionary fiscal policy to help those people. And so I think it's really important to focus on, even if, say, you look at like me going to school as an engineer, I was looking at, companies like Amazon or, SpaceX or Tesla, or these really cool company, Google, these cool companies that have, that make the most money, that give a lot of cool perks. And, when I thought about what I wanted to do for my work, for my future as an employee or, just as a person, was I wanted to have the most work-life balance, most freedom that I could have. And I didn't want to have the stress of whether or not my job was going to be there based on specific contracts, occurring. And so that's why I chose what I did. And I think that's something that's very important to keep in mind for long-term planning, because recessions will always hit cyclical industries harder. So if you're in one now, more power to you, and good luck. And hopefully it doesn't get much worse, but or even look and see, maybe there are options outside that have the same skill sets, but with a company with a little bit different economic factors. And cool, that is the end of that one. So let's look at the chat now. Okay, so first of all, so Vince. So I'm not invested in Tesla, actually. I am, I'm kind of a boomer when it comes to investing. I'm very Warren Buffett, Charlie Munger school of thought. So I did buy Tesla back in the day, and I just sold it way early because I felt that it was really overvalued. I bought it at like 200, 220, something like that, and sold it at like 500. And yeah, shouldn't have done that. I broke my own rule. Generally speaking, I want to hold stuff for the long term, but when a PE ratio is over like 30, I just have a really hard time holding on to a stock if I'm already up on it by a bit. Because I generally speaking want stocks that have a PE ratio at least below 30 if they're like a high growth stock, but if not, then I want it below 20. I want deals. I mostly, so like right now as an example, I'm buying a lot of stuff that is just below book value. That's kind of my main thing. And to answer your follow-up question, yeah, so single companies I'm invested in, essentially my main one is Facebook. That's my biggest investment. And that one I'm got like a cost basis of like 150. So that one's doing really well. Other than that, the ones that I'm also invested in, so like generally speaking, I like to pick so I like to go, and so, everyone has different perspectives on this, but like my general thought is most of my money that I invest goes into S&P 500 index funds. And and then, so like, as an example, I put about 22% of my income into either retirement. I put like 21% just straight up into S&P 500 index funds and don't touch it. That or bonds or emerging markets, but low fee index funds. Then with like about maybe 5 to 7% on top of that 21%, that's what I put in individual stocks. So I want to first point out, I think it's very important to have a base of low volatility, long-term, safe investments in index funds, and then consider single stocks as generally speaking extra. And when I pick those, I still am someone that wants to try and mitigate risk. So I'll usually pick 2 companies within an industry, one that's a little bit more of an established with the high dividend, and one that is a lower market cap company, but has a little bit more growth potential. And so like, as an example, let me look real quick. As an example, in my, in like the banking industry, I have like Citigroup, and I have Pacific PACW and Pacific Pac Bancorp, and those are really good for me because when I'm looking at it, let me see real quick on here. Yeah, so those are really good for me because Citi has like a 5% dividend. It's low. It's even now, right? When banks were hurting pretty bad. So even in its worst time, it was like maybe 7, like pretty low debt for a bank. Banks usually have high debt, but the main thing I was looking at was the P ratio was like almost single digits. And it was a steal, and its dividend payout ratio is like 40%, which is insane considering that the low earnings are around. So it's very safe, and it's grown for about 10 years straight. So I'm trying to build up big dividend positions, generally speaking. And then I also have growth stocks, but a lot of the stocks I have right now, outside of Facebook, CVS, Citi, PACW, a lot of the, and then Fizz. Fizz is a really good one. That's National Beverage Corp. It's the company that does LaCroix. And that was one that I got tipped off on by Financial Education, Jeremy from Financial Education on YouTube, really good channel. And essentially, I think I bought in that at like, I bought in at that at like something ridiculous, like $50 or something like that, and it's like 90 now. And I'm holding that long term because I think it's got a lot of growth potential. But yeah, the main ones I'm looking at right now are Facebook, CVS, and then whatever I'm able to get. So like the other ones that are a little more speculative are G1 Therapeutics. GTHX is the ticker symbol. I like them a lot. They have a lot of growth potential. And it is, it's a really good one. It's also a low cap price, so that's attractive for someone who's trying to add a little bit each week. And iHeartRadio is actually really good. It was like at 50% of its book value when I was buying it. So, getting it at $7 when it's a $14 with $14 book value with low debt, it seemed like a no-brainer. So that's the general strategy. And then for like right now, the only stuff that I've been buying recently has been, other than index funds, has been Honda Motor Company, because its book value is around $45 and it's a $26-ish stock right now, with, good debt and everything else. And then Viacom, because it's about the same. It's about its book value, good dividend, strong company. I think it's just being hurt by sports not being on for the last couple months. Yeah, so those, generally speaking, looking at right now, because I think everything's kind of overvalued relative to the state of the economy, I am looking at stuff that is very cheap, but not looking at but also trying to avoid value traps that are, say, like I'm not buying airlines right now. Let me put it that way. I think that those are very precarious. I am holding Delta, sadly, still, but I'm not going to sell it, but I'm not buying anymore either. And then for the googly smoog. So no, I don't have any updates on Nikola. I may be a curmudgeon on this, but in my opinion, I think that EV car outside of Tesla right now, I think a couple months ago it was a great investment. I bought Neo a couple months ago, and I think that was a great investment. I bought it for I think $2.50. It's insane, and it shot up several 100%. But that was all because the hype of Tesla, around Tesla the last couple months, especially before the split. I think the issue you had was that Tesla was, all these people that were quote unquote like normie investors were looking at Tesla as too expensive for them to buy per share. And they're like, okay, how can I get in on this pie? What else can I buy? And then they just went for, workhorse, Nikola. And I think that's something to keep in mind. For me, it's a little bit too risky of an investment right now, but if it drops back in price, then I may look at it. So sorry about that. But I know I'll put links of other people that have good stuff on that. I know Meet Kevin does a lot of updates on Nicholas, so definitely check his stuff out. And then Brett Anon. So as someone who has invested entirely in index funds so far and who hasn't looked up individual stock investing, what resources would you recommend, books, etc.? Yeah, so I think so it depends on how you want to consume your media. I love video, so I think really good places to check are The Compound. That's a YouTube channel. It's run by Josh Brown, and Josh Brown is like the lead of a investment firm. So they're very good, level-headed analysis, and I think their macro views on stuff is very, very good and helps. I think balancing that out with people like Jeremy from Financial Education, who sometimes is a little bit too much hype, I think is really helpful. As far as books, anything by Warren Buffett is anything along his lines, in my opinion, is the best. The Little Book That Beats the Market is really, really good. That was one of the best ones that I read early on that kind of got me into this. And then one that I always suggest as a book for like anyone, regardless of investing or anything else, is How to Lie with Statistics. It's a great book, and it's very thin. I think it's only like less than 200 pages, I think. And what's really good about it is it gives examples of companies and other institutions using numbers to psychologically, get different actions out of people. And I think having a better understanding of that will help keep you more grounded, which I think is the most important thing to do with investing. And then the last one I'd say is the best one that I've seen for like a video on it or the book is I Will Teach You to Be Rich by Ramit Sethi. And if you don't go buy the book immediately, if you don't want, instead check out Tim Ferriss's podcast with Ramit Sethi. That is probably the most value for your buck 2 hours that you could probably ever spend, at least that I've found, on investing and just planning for, a fulfilling financial life. So let me get a sip of water and then or yerba mate rather, and then I will get on to the next topic. Yes, Nikki, 100%. I'm glad that I'm glad that you are reading it. Yeah, so now getting to the next topic. So the next topic is going to be I'm going to go over a couple different reactions by the government as far as law and specific policies that they are looking at as options to help deal with this, issue the COVID issue that we have. So the first one I'm going to go over is the payroll tax deferral. So essentially what it is that it's Trump signed this in, and basically it's allowing employees to defer payroll taxes, which is 6.2% of your paycheck that goes to Social Security from September 1st to December 31st for those making less than $4,000 per 2 weeks. So you may be affected, you may not. But essentially, and Trump's economic advisor, Larry Kudlow, says that they're pushing to forgive this deferral in the future. And so that's the big kerfuffle that's going on right now, is whether or not this is even something that they can do. And the reason is that there's no guarantee that this forgiveness will pass in Congress. The 6.2% employer contribution portion of the payroll tax, which is what's on the table for the chopping block, that's used to pay for Social Security. So when you look at your paycheck, like if you have, a normal W-2 job, on your pay stub, you'll see something taken out for SSDI, which is Social Security and Disability Insurance, and 6.2% will come from you as the employee. That's your employee contribution to Social Security, and then 6.2% will come from your employer, and that's your employer contribution to Social Security. So the issue is that Social Security is not part of the discretionary budget. It's part of the it's part of the guaranteed budget, essentially, so of the U.S. government. And the issue is that without congressional approval, they can't just not pay that. It's going to have to be paid at some point, and it's very unlikely with a democratically controlled House that it's going to go through the Senate and the House to be actually passed. So this seems a little bit of just playing politics to me, but we'll see. But as far as how it affects normal people, employers are able to choose whether they want to participate or not. And, if they do participate, then what's been talked about is that they may, allow higher pay checks for, the employee this year through the end of December. But if they did, they are assuming that they would have to make up the difference at some point. And the problem is that they might do this by, if they give you 6.2% more from September through the end of December, then the first 6 months of 2021, you might be getting 6.2% less to make up for that. And then this doesn't even deal with the issue of, okay, well, what if you work, you don't work there next year? How are they going to then get those back taxes essentially from you because it's paid through the employer? So this is a really big issue that is not going to be easy to fix, that we need to keep him. It seems like just political pandering, in my personal opinion. And I will talk about another one, so stick around for that if this upsets you. I'm sorry. But essentially, it's doubtful that the White House and Congress will be able to come together on this, in my personal opinion. And I think it's been proven based on how much of a how ridiculous it's been with Congress just trying to agree on stimulus checks and bailouts over the last several months. And the big issue you have is that, forgiving this deferral, and this is my personal opinion, forgiving this deferral seems to be a roundabout way to start, normalizing making cuts to Social Security. And that's something that we definitely need to be very wary of. And the reaction from businesses is that a lot of them, aren't going to participate because of there not being a guarantee for what's going to happen in the future. Federal employees, though, will have this deferral automatically taken out. So that's going to be interesting to see how that's going. If you're someone who works as a federal employee, definitely, reach out if you want to talk about this. I would love to have you on and get better insight into what, how this is affecting you. But, and then public sector unions, have been heavily opposed to this, and they want an option to opt out, given the clouded future around this. And, same, if, you have access to someone who works in one of those, I would love to talk to them. But yeah, it's something we need to really keep in mind because, it's being forced upon these people that actually work government jobs. And so from this, the lesson that I see is, like I said, it seems to be a Trojan horse for cutting Social Security funding and normalizing that in the future, which is definitely something to consider very, very strongly, like whether or not we're okay with that, because 90% of people over 65, and I'll have, again, links in the description, 90% of people over 65 use Social Security. And on average, it makes up an average of around 75% of their income, like something like 60 to 84% of their income. And that's according to like Social Security, like .gov. This is something really important to keep in mind because we definitely want to make sure that we're taking care of the people that are in the most need first, at least in my view. And also, most aren't going to utilize this anyway. So again, I think it's mostly just playing politics. At least that's what it seems like to me so far. But yeah, so that's the end of that topic. Back to the chat. Thank you, Dimitri. I appreciate it. Loved your video this morning. If anyone hasn't, definitely go check out Dimitri's video. Yeah, really good stuff. And also, I did not mention this. I meant to, so thank you for the reminder. Whenever I was talking about where I'd been in the last month, yeah, I had the pleasure of going on Dimitri's podcast, the Rise Productive podcast, and definitely go check that out. It was a great time. Look forward to doing it in the future, and definitely check his content out. And Francis, hey, like I told you last week, whenever you were asking where I'd been, I appreciate you reaching out and seeing how I was doing. Yeah, I had to take a little bit of time off, but I'm back and this is going to be the norm. So appreciate you watching. And with that, I'm going to get another sip of your mate and some water, and then I will get on to the next topic. Awesome. Okay, so next topic is the rich have been getting richer during COVID-19, and this is definitely something we need to, be focused on and, at least questioning whether or not that's something that is a problem that needs to be dealt with. So essentially, again, we're looking at, the highest unemployment number in decades. Large businesses have been benefiting much more than small businesses. And those small businesses are hurting the most, especially in the travel, service, retail. They're getting hurt the most, while companies that are able to, essentially the, quote unquote, work from home economy, are benefiting massively, like Amazon, Zoom, and so on. Even more so, the employees of these companies are being forced to work in, quote, like riskier conditions with no pay increase. And that's something that's a real big issue, especially when you look at, say, Amazon. And don't get me wrong, like I'm not, we all use Amazon, right? I use Amazon, but we do need to keep in mind that there are serious issues that are going on right now because Amazon is definitely benefiting astronomically compared to other companies. And at the same time, during this, when they're having more volume, workers are having to do more, they're not paying them more. And on top of that, they're not allowing them to unionize. Like they have been actively pushing down unionization at Amazon during a pandemic while those employees are working in warehouses in close proximity, touching thousands of packages at night. And, this is a real issue we need to consider as a country of what are we, going to do about this. I know for me in college, I worked for 5 years at UPS as a package handler. And I know that I can't I know people that still work there. I talk to them pretty regularly, and it's crazy. Like it's crazy what they're having to deal with right now, because while a lot of us are in situations where like we have a little bit more laid back lifestyle, we're at home more, or hours are being cut at different places, which all have negatives as well. These people are working more and not getting paid more for it, and while their companies are disproportionately benefiting. And that's, yeah, definitely something to keep in mind. And those that have been deemed essential employees, regardless of industry, are the most economically at risk on top of that. So they have the most at risk, both medically, because they're the most, they're coming in contact with people more. They have more chances of ending up having a medical, issue that they will end up having to pay for. But they're also doing that because of the economic pressure that they feel to work those jobs, even when the conditions are not, at the best that they, should be. This is definitely something that is, that in my opinion, we need to have reform to try and fix. And then when you consider that increased medical cost due to higher rates of transmission, because obviously there's more people that are going to have, medical costs this year than there have been in other years, based on the fact that there are more people getting sick. And then on top of that, you have, adding insult to injury, you have America's billionaires that have increased their wealth by around 650 billion since the pandemic. Now, as far as the start of the pandemic and where they're measuring that line, and again, I will post articles below, but where they're measuring that line, I do think that there is a discussion around that, and I'll cover that later, about whether or not that's a truly fair comparison. But the reality is that we do need to, at least question what's going on. And so, similar to the payroll tax deferral, another policy that has been proposed is the Make Billionaires Pay Act. And this was introduced in the Senate by Bernie Sanders, Ed Markey, and Kirsten Gillibrand. And this was the proposal was to impose a 60% wealth tax on gains made by billionaires between March 18th, 2020 and January 1st, 2021, and then using those funds to fund out-of-pocket healthcare expenses for all Americans. Now, like the payroll tax deferral, while I think that this is definitely something that should be like a wealth tax should be discussed on the table, given the increasing wealth gap, I do think that this is a little bit similar to the payroll tax deferral in that it's not going to pass. It's not going to pass in a GOP-controlled Senate. And also, I think that starting it at March 18th is kind of disingenuous. I think that you have to, because when you let's look at a chart real quick, and I'll show you what I'm talking about. But basically, the pandemic obviously started before March 18th, but that was when the government had fully acknowledged that, it was something that we had to deal with. But basically, let's look real quick on here. Let me show you guys what I'm doing. So basically, when we're looking at this S&P 500 chart, so I'm just going to use that for the market as a whole. Right here, is March 23rd. That was the bottom of the market day. Remember it very well. And because I was buying a ton. And March 18th, right here, March 11th, I believe, was the first day where Trump actually called it a pandemic on TV. But March 18th was when they were doing this line of demarcation. In my personal opinion, I think that late February would be a much more fair assessment of when the pandemic started, because that was when you started to see this first slide in the economy. And that was definitely from COVID. I know that for me, as an example, I was buying right here in like late January. I was buying a bunch of like 2 and 3x inverse ETFs on semiconductor and tech stocks, because it was very obvious that these economic changes that were happening, even if they didn't come to the U.S. and China, happening in China when most of our economy is driven by FANG stocks. Those FANG stocks are getting most of their equipment, like semiconductors, from China, Taiwan, Korea. It was very obvious that we were going to have a downturn, and I think that would be much more fair. So again, I think there's a little bit of political posturing going on with this, but it's something to keep in mind, at least as far as discussion. And I think that's something that'll definitely be brought up within the discussions in Congress and on the Senate floor. Those will definitely come up. People are going to question it because it seems fairly evident to me. And, a lot of wealth gained has been in stock appreciation and is not liquid. That's the other real big like pushback that people have on this. I know I saw like Andrew Ross Sorkin and others on CNBC talking about this, saying that like, Bezos as an example, how are you going to tax him 60% on his wealth increase when, most of that is in stocks? Well, if you're someone who's struggling right now, I think your answer, you don't really lose sleep over saying that he should sell those stocks and give more to people. But it is definitely something to keep in mind because obviously that's going to affect Amazon stockholders as well. And I don't see people in Congress that, likely do hold a lot of stock in Amazon and otherwise hurting their own pockets by, forcing that. That being said, I do think that having a wealth tax is a good idea in principle, especially in contrast with, our social safety net relative to other countries worldwide. I just think there's a couple hangups in this bill that will end up keeping it from getting passed. And I think we need to reform and enforce employees owning / being compensated with more stock. And less being held by the CEO. I think we should put in reforms for say X% of companies, like X% of a company, like say 75% of a company or 50% of a company should be owned by the employees. And what I mean by that is that employees are owning, they have ownership stake, they have stock. I think that allowing CEOs to mostly be compensated in stock is a really bad thing for the average person. And I think this is really obvious, especially when you look at, say, airlines. And right now, the contrast, because, airline employees are getting hurt really badly right now. And their CEOs are mostly paid with stock. Well, guess what? During after the 2008 financial crisis, whenever we bailed out the airlines the last time, the airlines have been the number one buyers of their own stock since then through this process known as stock buybacks. And so stock buybacks are essentially where a company is able to buy shares of its stock. And in principle, this is used when the company thinks that their stock is cheap. They would buy it. That would end up increasing the price of the stock because more people are buying. And therefore, they make money off of that appreciation. And the issue here is that this benefits the people that are the executive suite at those companies because they're essentially raising their own stake in the company with company money, when they could instead use that to give, say, either shares of stock back to their employees as a bonus or give their employees money. But instead, what you've been seeing is that when you have these cyclical downturns, whether in 2001, 2008 financial crisis, or COVID, you see these downturns, and then what do? They cut, they cut the amount that they'll pay, they cut routes, so they cut hours, and then they furlough / fire people. And this is a real problem that I think was a really big issue with the bailout bill as well, is we needed to put more restrictions on stock buybacks because it's a negative incentive for companies it incentivizes them to not do what's in the best interest of their employees and to instead just keep pumping up the valuation of their company, which essentially also is showing artificial growth. Because the reality is airlines, like I was saying earlier, are more like a public utility now than any other time in history because, we're increasingly more globally interconnected. So there's just not much that they can increase on, like from a, strategic standpoint. There's not that much difference between what one airline is going to be able to do versus another airline within the U.S. economy. And if you've ever traveled internationally, specifically if you've traveled on, say, like Emirates versus American Airlines, you'll definitely see this because those companies, especially in the UAE and a lot of airlines worldwide, I know Korean Air is the same way. they are actually publicly owned. So what that means is that they don't have profit motives. And that ends up, that ends up giving more value to the people flying on them because they don't have to make money off of it. So you take away however much percent profit they would be making and put that back into the company, and it's a better service for those people. And I think that's something that we should look at because, as an example, like I said earlier about my father and brother both being pilots, when you look at, say, a person who wants to go and fly for Emirates, they get paid way more than people, that work for American private airlines. And it's definitely a thing to think about. So anyway, and then I do think we need, like I said, to add some type of wealth tax or higher income tax. Like I said, this goes back to the contractionary fiscal policies that I think we need in times like right now versus the expansionary fiscal policies. I think we have to do that, and at least do it as like an incentive. Like, say, you have a company that has, quote, that defines certain workers as essential. I think that we should put a restriction on those companies to either have a higher minimum wage for those workers, or I think that we should have tax credits for companies that do meet a certain standard and tax companies that don't more heavily, because we need to do something to incentivize them to not, take advantage of their own employees, when they're doing well. And then I think we should do the same with companies that push against unions and workers' rights. I think that those companies should not be allowed to benefit if their workers are not also benefiting at the same time. I think we need to do something about that. And while I think that the Make Billionaires Pay Act is not, I think it's mostly political posturing, same as the Payroll Tax Deferral. While I think it's not necessarily going to be effective, I do think that there are some decent ideas within it that we may be able to think about in the future. And with that, I'm going to come back to the chat and see what's been going on. So, Francis, thank you. I really appreciate that. Yes, I agree. It was great. And, yeah, Dimitri does great videos, really good content, and it was great getting to talk to him. And it was amazing how good of a conversationalist he is, because that was only the second time that we had talked together, and I felt that it was extremely natural and very, very good content. And Francis, feel this so deeply. I work for Brooks Brothers, and our company declared bankruptcy during all of this. We are a larger corporation, but we are a specialty retailer. Luckily, we were just purchased. Well, I'm glad to hear that for you, because yeah, it is. It's a hard time, like it really is, and I'm fortunate enough because my job is like, my job before the pandemic. I did go into the office, but I was able to do it perfectly, like 100% remote, which was part of the reason that I chose it initially, and I'm very thankful to be in that position. I know it's hard, and I grew up seeing my dad when I was like in third grade, was when September 11th happened, and I remember seeing my dad go through getting his pay cut in half, and like a lot of his like pension and 401k taken away, like the matching of the 401k. Obviously, they didn't take away his 401k, for no reason of his own, just the fact that the airline industry lost money during that time because less people are flying. And then I saw, by the time it caught back up in 2008, 2009, same thing, it dropped all the way back down. And don't get me wrong, I'm well aware that there are other people within, the economy that are hurt even more because they don't have that type of a job to begin with. And that sucks even more. But yeah, that's why cyclical industries are really within our economy in the U.S. It's a very precarious thing if you don't have a really good safety net, either individually or publicly. Thank you, Vince. I appreciate it. Glad to hear it. I like this style more because I feel like I know you talked about it in one of your recent videos, about how you don't script your videos, and I think that's a really important thing because I think it helps you not be so stilted in language because you're able to like free flow, and I like that a lot. And so yeah, I think this is a good way to do it, and it allows me to be able to speak a little bit more on a topic if I realize later on throughout it, as opposed to having to, as opposed to realizing it when I'm editing it, which is always a pain. And thank you so much, Nikki. I really appreciate it. And C Jinda, thank you so much for watching. Really appreciate it as well. And yeah, Vince makes great content. So anyone else watching, definitely check it out. And in just a second, we will get on to the last topic for today. Okay, and as if you haven't heard it because you weren't here earlier, I am going through each topic, and if you ask questions, if you have any questions about the economy, policies, if you just want to know, whatever, as long as it's something that I will want to answer, then I'll definitely answer any questions that are in the chat in between subjects. So, last subject of today is on woke corporatism. So this is something that I think is really important and has been pushed to the forefront recently because of a lot of the social issues that have been going on in the United States, both with COVID and and outside of COVID. But specifically, I'm going to focus on, because it's the more relevant one right now, is a lot of the Black Lives Matter stuff. So, and regardless of which side of the issue you're on, I think you'll be able to see eye to eye with me on something within this. So don't run away. But basically, what is woke corporatism, or what am I defining it as? So it's essentially where companies, in response to social issues, make ads around them, and you essentially are socially posturing. So the classic example is Kylie Jenner in the Pepsi commercial, or like the Gillette ad a couple years ago, talking about toxic masculinity. And I think it's really important because while those are, of course, issues that I do think are important for the social, discourse, we have to keep in mind that we shouldn't be getting, and right now it's the NBA, the NFL, where NBA players are doing, a protest of, say, police brutality by, doing by doing a walkout, basically a strike. And then the NBA and the NFL capitalizing on this by saying that, they support, Black Lives Matter, or they support this, specific athlete that stood up in this way. And I think that regardless of which side of the issue you're on, I think that a lot of people find that very disingenuous, because it is. I think that it's important for individual employees, athletes, people to stand up for things that they believe in, and to be able to do that without retribution from their company and retaliation. But I think it's important for us to remember that that private companies don't, their motive is profit. They don't have moral values, and we shouldn't be deriving, morality from them. I think that oftentimes they are, we center our lives around our job, whether it's getting valuation, getting personal validation from working for a specific company that people know of, or, looking at it, say, well, Starbucks didn't, put like Christmas on the cup, so I don't want to go there because they're anti-Christmas. They don't care about Christmas. They don't care about happy holidays. That's not what it's about. They care about what is going to make people want to come there, and whatever is going to make more people come there and make them more money is what they're going to do. And we need to all keep this in mind, because this is reality. And whether we are on one side of, a specific social issue or the other, we shouldn't let companies divide us on that, because they don't really care. They're chasing profits. This serves only one thing, in my opinion, and that's to make people feel good. You look at it from the perspective of oh, company A agrees with me because they support this issue, therefore I'm going to go there. It's not real. Now, I will say, if you're in, say, an area where you have a lot of, smaller businesses that are either like family owned or, locally owned, I think that in those scenarios that, yeah, if they're treating workers in a way that is really, that is beneficial, if they're good for the community, if they make a good product or service, then yes, we should support those. But I'm speaking specifically on, say, corporations like Starbucks. And don't get me wrong, I love what is it? I love their drinks. I love their caramel cloud macchiato, but I also don't go there because I think that they are socially progressive. I think that when you look at a company like that, that is oftentimes trying to posture as though they are socially progressive, and then you see stuff come out about how, they aren't, like, they're paying employees less, like the minority employees less within their airport locations because their airport locations are not, or they are franchised, so they don't have the same restrictions as Starbucks corporate. I think it's important to look at the merits of what those companies are actually doing for workers, and whether it's minorities, like when POCs, women, sexual orientation. Regardless, I think it's important to look at the merits of what they're doing and to look more at individual actions instead of just being happy they're on our team or not. And like I said, I do think that individual employees and athletes can and should make a difference, and without retaliation. Good examples of this I know right now is, Kaepernick is what people are, aware of, but I get that that's a polarizing figure currently. But ones that, if you want good examples throughout history to look at, are John Carlos and Tommy Smith from the 1968 Olympics in the 200 meter 4x200 meter relay final. It's a really good example. Definitely look it up and read up on it. But basically, the idea was that in 1968, in the Mexico City Olympics, John Carlos and Tommy Smith, who are both two black sprinters from the United States, finished first and third, and they decided to protest during the U.S. national anthem by holding up, a fist with a black glove on each of their hands. And like I said, they were the first and third fastest person at 200 meters in the world. And they ended up getting ostracized and never allowed to compete for the United States again, because of that protest. And so did the white man from Australia, the sprinter that got the silver, because he joined in by giving them, he was the one that gave them his gloves for them to protest. And he also was not allowed by the by the IOC to compete again. And I think it's really important to remember this, because we always, in the moment, we react to a specific, figure or situation or posturing. And like, Kaepernick or Nike or companies doing this. But I think it's really important to look historically at the merits and realize that, people who stand up for issues in society always do get ostracized at the time, but end up getting more embraced later on. But the point is people, not the companies. That's the key part. Another great example. One moment. Another great example of this is, of course, Muhammad Ali. Ali, if you have a parent, my dad was in the Marine Corps for 22 years. If you have a parent who is, very pro-military or was in the military during the 60s to 1990s, so around that Vietnam period, oftentimes they will still have issues with Ali to this day, even though a lot of us, if you grew up like I did in the late 1990s and early 2000s, you probably have a pretty positive view of Ali. But back then, people didn't, because they felt that he was, a draft dodger, that he was not doing, not serving his country, and he was just looking for an easy way out by saying that he, was not that he was Muslim, therefore he was not a proponent of the, the war that was going on in Vietnam because of violence. But they always leave out that he didn't that wasn't really his gripe. His gripe was that he felt that he is a a Black American was not represented, and he didn't feel that he should put his life on the line for a country where he was still called slurs in public. And if you actually look up the interview from where he initially stated as a conscientious objector, that is literally what he says in much more colorful language that I will refrain from. But yeah, it's really important to keep in mind, because people think, they'll talk about it and say like, oh, he took the easy way out and this and that. It's like he literally lost 3 years of his career in his prime, his peak earning years, because of that. That's something that we need to keep in mind, because we shouldn't villainize individuals for standing up for what they feel that they deserve, what they are willing to work for, what they the respect that they feel they deserve. We should always look at the institution that causes that and make sure that we don't fall prey to whatever narrative that it is presenting, and instead listen to the individual people. And so I think that it's important, like I said, that we don't look to companies as moral compass. We realize what they are. They're looking for a way to, make money, extract resources, and provide products. They are not, they're not our friends. We can work for good companies, don't get me wrong, but it's the people that make up that company. And I think it's also really important to keep in mind that companies use these types of things. I know there was a lot of controversy around White Fragility, the book that came out, and how controversy on both sides, both the right and the left of the American political spectrum specifically, where the right looked at it as this is, virtue signaling. This is a way of, quote unquote, atoning for past sins. And a lot of people on the left also looked at it as this is not productive. This is just essentially like HR departments trying to find ways to get, to have more programs so they have more plausible deniability in the case of a lawsuit about discrimination. And I think that's a very important thing to keep in mind, that we have to remember that, we should be working on stuff together. Polarizing things like this are not helpful. That's my opinion, because I think that the problem is that it ends up making it so that those companies are then able to essentially scapegoat people and not take responsibility for, like I said earlier about Starbucks. These companies are a lot of the time responsible for the systemic reasons that, these social issues occur. Like if companies are essentially putting an economic squeeze on people by paying people less and forcing them to work in worse conditions because it makes them more money. I don't really care what their HR policy is on, systemic racism. They need to do something, I want to see what their actions are. And I feel like that's something that we, as, a country, and worldwide, should be able to agree on, that that's not helpful, that talking to individual people and treating people as people, while trying to reform the systems that, deal the outcomes that those people are dealing with. And because of this, I think that's generally a counterproductive thing, because, people on the right definitely have a point in being upset with the, with this, because it seems as vapid social posturing, while ignoring the root of the problem. And I think it makes it easier for people that already, are, think there isn't an issue. It makes it easier for them to say, look, this is just, empty. This is virtue signaling, and it just causes nothing to get done. That being said, I think for, us as like individuals, I think that it's important for us to raise awareness. And I think that's really effective. And I think the best way to do that, is grassroots, organically, talking to people that we work with, talking to people that we know, about their life experience, about our life experience. And I definitely want to do that in the future. And that's part of the reason that I changed the name um, from Engineering Success because it's a Wealth for 99 because I think that that was the ultimate goal of the channel anyway, is to talk more to the average person and talk about how to financial plan and build wealth for the average person. And I think that's a much more a much better, name and name for it. And that's what I want to do. And in the future, I definitely want to talk to more people. And that's the goal of this, is going to be, as I get more of a platform, is to get more people on to talk about their life experiences and talk about how, financially what they're doing, what problems they deal with, so that we have a better idea of, what's going on outside of our bubble. And so, like I said, on this issue, I think people on both sides say, of the BLM argument, hate woke advertising. And I think we need to call it out to effectuate real change. And I'll also put a really good link in the description from Coffee Break. If you want a great video, like video essay style, with really good visuals from a year ago, Coffee Break is a YouTube channel who did one on woke advertising, and it is phenomenal. So I will put that link in the description box below. And yeah, that's for woke corporatism. I'm not a fan. I don't think anyone is. So, except for the corporations themselves. And with that, that is my last topic. So for today, I'm going to go through the live chat. And if you have any other questions, you want to follow up on anything that I've talked about, or you have any other questions, I'm definitely going to look through those. And let me get a sip of water and I will get there. Yeah, in the live chat. So Francis, yes, I 100% agree. I've been very, Francis said, love this point, Drew. Merits are everything, and employee treatment speaks volumes in comparison to a marketing stance. I 100% agree. I might be a hater on marketing, but yeah, I think that the companies I've worked for have been I worked for other companies as well, growing up, but the main companies that I've worked for have been UPS, and then for, like I said, 5 years, and then for the Aerospace Corporation, and both of them have amazing corporate atmospheres. Don't get me wrong, I don't think that the CEO of UPS, cared about me at all, because that's not in his prerogative. However, I know that the people that I worked with, even though it was a very hard, physically demanding job, I know that I loved everyone that I worked with. Like, I really, really enjoyed having that type of a working environment, because we were all, on the same team. We were all working together. We were all there to support each other. And it's some of the best friendships that I have, because I think you build the best friends in the hardest times. And so, yes, I do think, yes, employee treatment by far that's the way I measure how good a company is, personally. And Nikki, thank you. I appreciate that. Yeah, I think it's important to have a good historical understanding of the background of why certain things and reactions occur, in order to have a better understanding overall. And Jashim, yes, I really appreciate that. Yeah, I will have the full. This is my first live stream, so I will see how it goes as far as the upload. But I will have the replay up later, and I will also clip out each of the topics so that there are shorter videos for people that don't want to sit and listen to me talk for an hour and a half. And then C. Jinda, a moral compass is difficult to maintain. Yes, that's very true. And I think it's not. I think the point there is that, and this is again my opinion, but like, I view it as my moral compass and your moral compass, may not, probably aren't the same, but I think that we can agree on core tenets that, allow us to have a better society, without stepping on each other's toes. And I think that's us as individuals' responsibility, not institutions. And I think oftentimes institutions use the differences in people's moral compass to take advantage of them. And that's the main thing that I want people to realize when, Tesla talks about, like, and don't get me wrong, good, I I have a mug with the Starmen on it, like that, SpaceX sent up in the Roadster. But, I think when a company like that, as an example, talks about how they want to solve, global warming through selling $40,000 EVs. I don't think I don't think that they are morally better for that, because I don't think that that's something that's going to, I think that there are a lot of other systemic changes that need to happen. I don't think enough people rather are going to be able to afford EVs anytime in the near future. So I think that we would be better served by investing in, say like public transportation and making, sustainable public transportation more affordable, than, the propaganda that certain people will put out. So I think that's important to remember. And companies do the same thing with environmental stuff. I'll definitely, that'll be a topic in the next videos, in next week's video for sure, is environmentalist movement and companies selling environmentalist ideas, because that's, things like selling the idea of an environmental, your personal carbon or environmental footprint, I think is another way that companies use to scapegoat individual people, when the reality is that they're responsible for the vast majority of, plastic, carbon emissions, the different things that are actually causing the environmental issues that we are dealing with, especially here in California, but right now, but, worldwide long term. And then CGendo. We all know what we think is the right thing to do, but the backlash these days is amazing if the opposite is louder. Yeah, I 100% agree. And I think that feeds into the same lizard brain idea as woke corporatism. I think that oftentimes we focus too much on being right, than on what is actually right. We want to be perceived as being the person in the know, being perceived as the person who's morally upstanding. And that's a very selfish viewpoint, in my opinion. And it's something we all need to, constantly try and look from other people's perspectives to understand, why is it that they believe this? What is the systemic root cause of this? And, how does that systemic root cause, affect me? Because we all grow up with inherent biases. We all grow up with inherent environmental factors that are going to shape the way that we view the world. And I think that the best way to help with that is not to shut people down for having different views than us, but it's better to understand those people's different views, where they came from, and whether or not we've even evaluated our views. And I think personal growth is really important, and that's the only way to do it, is to be introspective and look at it. And the last thing I'll go, assuming there are no other questions, is on that note about personal development, is another YouTube channel that's really great that you should check out. Another small YouTuber is Inner Core Ari. She does really good videos, like insanely well done for the subscriber that she currently has, especially. And they are very good about, introspection, personal development, and just, trying to be more level-headed in a world where it is increasingly harder to be so. And so, yeah, on that, I want to say thank you guys for tuning in. Really appreciate it. Like I said, this is my first live video. In the future, I plan on doing one of these every week, and that way I can commit to actually putting out a video every week with, far less, time commitment than my normal grind. And yeah, if you have certain video topics that you want, I will put in a discussion tab. I'll put in questions for, if people have topics they want me to cover. And if there are some, I'll definitely try and get to them if I have enough of knowledge around it. And if not, I will try and get guests as well that can enlighten me more on stuff that I'm not anywhere near an expert on. Thank you guys for watching. Really appreciate it. And I will see you guys next week.